Hi guys, I'm Dave Brickell. I'm Head of International Distribution at FRNT Financial. I'm excited to moderate this panel today and to be joined by my guests, Alex Ryvkin, Chris Perkins and Jesper Johansen, to talk about what rollups are building in the space of interest rate derivatives on-chain and broadly about the interest rate derivative market. It's an exciting conversation for me. Having come from traditional finance and been involved in interest rate derivatives and knowing the importance that they've played in the world of finance and allowing the scalability of that whole world, that to be able to bring that into the digital asset space is going to be vital as we continue to sort of grow and replicate much of what we've seen in traditional finance in the digital asset space and on-chain. So I'm excited today to have this conversation and find out what's going on with rollups and where this sort of world is going. And I'll hand over to my guests. Alex, if you want to introduce yourself.
Thanks, Chris. I'm Alex Ryvkin. I'm the founder and CEO of Rollups. The easiest way to describe what we do is an interest rates DEX. We are currently running a private beta of a crypto-native rates trading product on Arbitrum. The goal is basically to make things like perp funding rates, staking reward rates, and everything else that looks like a rate in crypto ecosystem and potentially later on in TradFi as well to be tradable and settleable on chain. We have been in a private beta for around about 5 months, and we're going to announce some exciting things with our upcoming launch as well. My background is in traditional finance as well. I started back in, I think, 2010 in equity sales trading and slowly transitioned into derivative structuring, working between London and the Middle East for a while before I moved to entrepreneurial career and first in fintech and subsequently in crypto. Last thing I've done before launching Rollups, I was running product and technology for Copper, the institutional custodian in the space.
Hi, my name is Jesper. I'm founder and CEO of Nothstake. Nothstake is a regulated custodial staking provider based out of the Nordics, Copenhagen. We hold license to operate in Europe and in the Middle East, and currently working hard on pioneering tokenized staking, which is a liquidity solution for primarily exchange-traded funds, but also other regulated funds that allows them to liquidate their Ethereum validator nodes in a way that is compliant and allows them to improve the capital efficiency of their funds. So, yeah, that's me. Very exciting to be here. Thank you so much.
Great. My name is Chris Perkins. I'm the president of CoinFund. We're a registered investment advisor with pre-seed and seed strategies, venture strategies, so that's Series A and B, and then liquid strategies. We're also the founders of the benchmark we call Caesar, which is the first of its kind interest rate in Ethereum. We capture the mean annualized return paid to the validators. Previous to that, I had a career in the U.S. military, and then I transitioned to traditional finance. I ran 3 global businesses at Citigroup, largely focused on fixed income.
So Alex, I guess a sort of first place to start would be to kind of understand more about sort of rollups and dig a little bit deeper into the kind of problems you're trying to solve for and bring on chain, and just what does that look like?
Sure, I'll try to keep it short. We basically looked at all the lineup of the products which exist in crypto, and there is a big part of the TradFi financial product lineup which basically was non-existent at the time when we started at the end of 22. We've got spots, we got futures, we got options. We haven't really got swaps. We haven't got rate products available to kind of general investor, and 97% of those products are in TradFi traded by institutional investors. And as we saw, as I'm sure everyone else on the call will agree, the institutionalization of the market, we felt that this is a kind of a necessary component for a lot of products that people might be interested to build in the next cycle. Right now, what we're doing is basically solving two large subsets of of problems. Sorry, so we've got essentially two large use cases. One of them is hedging, and the other one is essentially speculation, expressing some sort of view of what's going to happen with the rates if you happen to have one. So for anybody who is trading perpetual futures or staking Ethereum or any other currency or lending or borrowing crypto, I think everybody's aware of the rates they are exposed to. It could be perp funding rates, it could be fluctuations of Ethereum staking rewards tracked by indices like Caesar, for example, and obviously the borderline markets are very volatile in crypto as well. So if somebody wants to protect themselves against that risk, be they the lender or the borrower, the payer or receiver, they can do it using our platform. Or alternatively, if a hedge fund manager or trading firm or even an individual investor has a view where the rates are going to go in the space, and there are plenty of firms who believe they know quite well what the projection rate might be. We are offering probably the cheapest in terms of capital allocation, so the most capital efficient product that enables them to express that view for like various sets of maturities.
Great, interesting. And I guess for the sort of wider panel, just interested to get your views. You know, we particularly when you look at ETH, you know, we start to think about you know, the yield component from staking as being like the benchmark yield within the crypto ecosystem. Just interested to get the thoughts from the panel in terms of, you know, why we think of staking yields as being similar to that of sort of benchmark yields that we'd get in traditional finance, and the potential importance of the role that will play. Oh, sorry, Chris, can't hear you.
Yeah, maybe I'll start. And one of the things that have been missing in crypto to date is interest rates. And to unlock the true power of interest rates, you need benchmarks. You need something that's standardized, right? Like think about shipping as an example. You know, back in the day, they would load ships and it was very cumbersome. And then all of a sudden one day, guys said, wait a second, what if we put everything in a box? We can stack it and we can do a lot of things. And so in order to truly unlock the value and the utility of the interest rate markets, you need composable benchmarks. Now, this concept of an interest rate happened because of the transition to proof of stake. And, you know, where are we in the market today? We're in the market where everyone's excited about the Bitcoin ETF. Oh my gosh, it has limited supply. That's so wonderful. What's next? Well, we have this thing called Ethereum, which is kind of like the internet bond. And it's really exciting. Why? Because it also has limited supply. You know, they're taking steps within the ecosystem to limit inflation. It has utility because you need Ether to pay for gas to power smart contracts. And then, oh my gosh, it has this thing called a yield. And by being able to standardize and observe a benchmark on that yield, I mean, it's so compelling because the traditional markets, interest rates are massive. The interest rate swap market alone is a $500 trillion market. Why? Because there's so much utility. You want to go buy a fixed rate mortgage, you need swaps, right? Interest rates are used in everything, borrow, lend. And the other problem with crypto is there's no naturally occurring fixed rates. Why? Because we don't have benchmarks that can unlock things like the swaps market. And that's why things like Rolabs are so important, because we need to unlock the utility. Last thing I'll tell you is that traditional finance, rates power everything. And we've had problems with rates in the past. They were closed. It was like LIBOR. It was manipulated. It's really hard to do that when everything's observable on chain. But I can't underscore the importance of rates within global financial markets. You turn on Bloomberg in the morning, they don't talk about companies that much. They talk about the Fed. What's the Fed going to do, right? Because it powers everything. And that's why this is so exciting. We're so excited to partner with Rolabs, and we think it's going to unearth next generation financial products and real utility across the ecosystem.
Yeah, no, it's great. I mean, one of the things certainly from my time at Lehman and kind of seeing, I guess, everything that went on there was, like you say, the importance of the interest rate derivative market was kind of huge, just to facilitate finance and for business to be able to hedge themselves. I guess the issue when you look back on what happened then was the fact that we had, you know, the the market built, as you say, to such a huge market, and then when problems started to occur, no one really kind of knew who owned what, right? So the lack of transparency around that, then all of a sudden the whole system came to a complete sort of freeze because no one wanted to lend, no one was paying back, and then the actual delays in settlement cause a lot of issues. So presumably, how are you guys seeing that? You know, do you think that we'll see, you know, given that this solves for a lot of those problems, that the traditional space will sort of all move on chain with these products? And if so, what's the delay? Like, what's taking so long? Because it feels like a really kind of drawn out sort of process right now in terms of getting this sort of traditional financial system on chain and comfortable with these products. Why is that taking so long?
Jesper, maybe you want to try it on?
Yeah, I'm a technologist at heart, right? Not an investment banker. So I really feel that maybe that's a question that someone like Chris or you will actually take on, because from our perspective, I mean, you know, at Nothstake, we think about, you know, interest rates and staking as sort of a logical next step in terms of the evolution of Ethereum, because with the ability to now own a piece of infrastructure like Ethereum, then all of the issues about risk management arise. And what Chris alluded to, then, you know, you need well-functioning benchmark rates, you need the evolution of interest rates on chain in order to unlock these things, right? So from our perspective, staking as this, you know, connecting your wallet and then passive income, that's sort of a thesis that we've abandoned, and now it is much more about, you know, how do we maintain an infrastructure investment? And the ones who invest in that type of infrastructure, they know and need ways to risk manage, and for that you need credible benchmarks, and you need an ability to be able to markets like Rollups, be able to engage into those markets so that you can take that risk off the table. And that's what we're seeing from our clients as well. A growing unmet need for this, because now we sort of understood what the power of staking and how it can be incorporated into funds. So we are also very excited about, you know, what's taking place with Rollups and our ability to provision these services for our clients going forward. So maybe that was not the answer to your question, David, but at least sort of a perspective from our side.
So David, I can chime in a bit because I shared your trauma at Lehman. I was there on the trading floor when we went bankrupt. And look, what happened afterwards was, to your point, people didn't know what was where. It was very opaque. And a number of different regulations came out that really forced centralization, frankly, because there were no other choices, right? There was no blockchain. It was just coming out. Bitcoin was just developed, you know, coming out of the ashes of the global financial crisis. And so what regulators do, they said, well, for all derivatives, you need to report them to a centralized repository. You need to essentially clear them, and you need to collateralize them, et cetera. Very prescriptive, centralized requirements. Now, with blockchain technology, we have an alternative. We can actually address systemic risk, I believe, more effectively through decentralization. You still have that transparency because it's on the blockchain, right? You're able to provide that transparency of who has what. And then the smart contracts, they don't discriminate against various things. If the collateral's there, they generally work. So, you know, I think, you know, we even saw an announcement today that NYSE in the equity space is trying to go to I think, 24/7 markets, right? That's an inevitability. It's already here. And when we go through the last little crisis we had in crypto, a lot of the issues were because the traditional rails didn't keep up with crypto rails. You know, you had to wait for your fiat collateral to come in. And so moving into a more decentralized derivatives environment, you know, should help address systemic risk. It should lead to more transparent and hopefully more efficient markets. That's how we see it.
Yeah, I would agree. It's almost surprising that it's taking so long, but then all of us are familiar with institutional lack of rapid reaction, let's put it that way. And that the inertia is massive, and that's one of the reasons probably why it's taking so long, even on the kind of crypto institution side, let alone the likes of about traded investment banks. But then one other problem Chris mentioned, the standardization, and that's across everything we do in the ecosystem, right? If you look at the business models of the top 5 investment banks, they're more or less doing the same thing, just somewhat differently, and some are more successful in one area of the business or the other, but they're basically running the same business model. If you look at the top 5 staking providers, they're all basically different companies approaching that completely differently. And even the question that that Caesar is trying to answer, like CoinFund and CoinDesk Indices with Caesar are trying to answer, what is the rate of Ethereum? There is no obvious answer. You know exactly what the rate of the US dollar is, but you do not really know what the rate of Bitcoin and Ethereum is. And there is no universally accepted methodology to calculate that. So if anybody wants to build a risk model of that, it's really it's a massive upfront investment to understand how these things work and to choose the right approach. And that's essentially what we're all trying to do, right? Through the regulated providers and transparent methodologies and on-chain things where it's kind of makes things more obvious rather than more complicated. Hopefully that's going to help.
I totally agree. Standardization drives scale, and that's really what we've lacked. And to get that standardization, like we do it all the time in every industry, but especially in crypto, it's how do you create social consensus? And with that social consensus and standardization, I mean, you can just unlock incredible value.
Yeah, for sure. Yeah, and I guess the other question for you, Alex, is, you know, in terms of the kind of clients that are coming onto your platform, you know, what does that look like in terms of sort of makeup and sort of backgrounds of those clients, and what does that kind of growth look like?
It's very interesting, actually. It was a kind of a learning curve for us because we started off thinking, okay, again, as I said at the beginning, 97% of interest rate products in TradFi are traded by professionals, right? And we thought, okay, we probably shouldn't be targeting the retail market that much. And we kind of knew that, but we discovered it yet again that the line between the individual investor and the professional investor in crypto is far more blurred than it is in TradFi, right? So you occasionally stumble upon people who, they might be even working for one of the crypto institutions who are not yet ready to participate in the market like ours, for example, because we're on chain, because we're a new asset class, it's a different risk profile, they need to invest a lot of time, but themselves personally, they are super keen on new products that answer an obvious need, and they see an opportunity, and they also understand the markets well enough to profit off it personally, right? So for us, you occasionally face the same people on the what you would call retail side, because it's an individual's account, right? And then the same person might become an institutional client 1 year, 2 years down the line. And the level of sophistication in crypto, as we found it, is a little bit binary, right? So we have people who are kind of still in the 100x or nothing meme coin mode. And we find people who are very sophisticated derivative traders, and they understand futures, they understand options, but still prefer probes because it's just easier. And they're happy to explore, and it's easy for them to understand the product. So what we found is there was a good mix of individual and professional client interest, and kind of more balanced than we expected.
I think the line between retail and institutions is blurring. You know, in the past, you just didn't have the opportunity, if you're retail, to have access to information and learn about advanced, sophisticated derivatives products. Now, crypto's changed that. They've really opened up, and that doesn't mean retail is any, you know, less sophisticated. You know, with open source, you know, information now and more access to understanding sophisticated products, I think retail's getting much smarter. And so I think that line in time will continue to blur. It's an inevitability.
I completely agree. And I think that, I completely agree. And I think that, I think, you know, what crypto and blockchain also does is that it provides, you know, it makes it accessible to retail people in a way where we as innovators and entrepreneurs are now finding ourselves building complex products or complex marketplaces, and, you know, making them available in a way that, you know, retail investors have never seen before. And the barrier for us will always remain sort of in how do we achieve sort of a parity in the usability in the UX as well. And that puts a lot of pressure, I think, on us in terms of how do we make these products, as simple as possible to use to unlock as much as possible, because that's also in the crypto ethos, right? To making sure that we can access these things. Why should it only be within the walls that we can access complex derivative products or so on and so forth? So no, I completely agree, and I think this is one of the things that one of the values, at least, that this did to my heart, is that we continue to work on making these things accessible.
Yeah, do you think there's a potential danger that comes with as well? And I guess is why the regulatory backdrop to all of this becomes so important. I mean, it's, interest rate derivatives, particularly over the years, have kind of had a bad rep. Certainly, Warren Buffett and calling them weapons of mass destruction, financial weapons of mass destruction. Is there a danger as well, like within that, if we don't have the right kind of regulatory frameworks to help police some of this stuff? Is that a concern, and how do we address that and kind of control for that?
Well, 100%. And we are internally, we are of a view that the potential for regulated DeFi, if you will, is much higher than for the unregulated, sort of completely permissionless DeFi. We think there is definitely always be space for completely public permissionless markets, but eventually, I think the regulators are catching up with the DeFi ecosystem. They understand much better than they did a couple of years, 2-3 years ago, when I spent hours talking to FCA about all kinds of things, including the on-chain activity, which they couldn't understand at that point in time. I think they're much closer to it now. And I think the clock is ticking for that argument that people used back in the day, or I'm just a software developer that builds things which then run on public blockchains. It's out of my hands. I think regulators kind of figure that out, right? The extent of control. They started talking about, do you guys use centralized or decentralized sequencer? That's the level of discussion they already have, right? So I think eventually we will all fall within the same kind of regulatory perimeter, just as another asset class, or through tokenization of real world assets, the same kind of asset class, but in a slightly different shape. So that's what everybody should be kind of looking to do, and we're kind of pursuing the same strategy. For the time being, we're running, because we're in a private beta and will remain in private beta for a little bit longer, we are a permission market, and we're being very careful with who are we marketing or even admitting to the platform too, because that's an inevitability in our.
I don't think it's fair to say derivative. Go ahead, Jesper.
Go ahead.
I was going to say, I don't think it's fair to say derivatives are weapons of mass destruction. The guy who said that actually is a humongous user of derivatives. And honestly, like it or not, they do deliver incredible utility as well, right? There's an incredible need for fixed rates. There's incredible need to hedge risk. You know how the global derivatives markets were started? They're actually started in I think 17th century Japan. For rice futures. They have their basis in agriculture, because they allowed farmers to hedge their crops, right? And so and modern day derivatives do the exact same thing. And I think we're seeing an entire economy emerging in crypto predicated on the staking economy, right? These rates are driving all different types of economic innovation. If you're running a staking company, wouldn't it be great to swap out some of your very volatile fixed rate returns for our floating rate returns for fixed income, so that you knew how to run your business? So, I mean, there's incredible utility that is going to be unlocked, through derivatives.
Yeah, and Jesper, your thoughts?
Sorry, I have some connectivity issues, so you can.
Goes in your back.
Can you hear me now? Yeah, can you hear me now? Yeah. Sorry, I have some connectivity issues. Can you hear me now? Yeah, great. Yeah, let me just try to pick up on that one. Yeah. So Chris, I completely agree that what we're seeing as well is this emerging need for risk management, and it doesn't, and it extends farther than that. I think with regards to the benchmark rate on CZ, it creates a lot of transparency as well, which is desperately needed in terms of from a staking perspective, up until this point, the narrative has been about, uptime and slashing events and so on and so forth. And in reality, from an investment point of view, that's not important. What is important is, are you able to deliver above the benchmark rate of the return for staking yield? That's what we want to look at, right? And everything sort of factors into that. And what we also get from having a benchmark rate is that we can start to take risk off the table, and I think that's incredibly important to build more complex products in the future. So in that sense, crypto is behind the curve on TradFi, which is kind of a bit funny, I think, or humorous, at least to me. So, but in the future, I think what we'll see also with staking and infrastructure as the base, hopefully we'll see interest rate markets develop in a way where we can enable better sort of fixed income products, and that would attract a lot of liquidity, as Chris was alluding to earlier, because the utility of that is just mind-boggling. So that's something that we are anticipating a lot.
Yeah, I think it's very interesting, like with crypto, that we're kind of going through the same evolutionary cycles that TradFi went through, but TradFi did it over kind of decades, and we're kind of doing it in a very, very short space of time. So yeah, we're kind of behind the curve in some respects, but we're catching up very rapidly, and we've kind of got the potential here to not just replicate the kind of product offerings that evolved necessarily out of answering questions, even going back to hedging out rice futures and all this sort of stuff, but the necessity of them to allow the growth to sort of scale and is sort of huge. I guess the opportunity we've got within sort of blockchain and is to basically solve for, again, the inefficiencies, going back to issues around visibility, around collateral, instant settlement, and all that stuff. So it's kind of the ability to replicate what was there in TradFi, and that developed over decades, to do that, but to do it better. And I guess the question for you, Jesper, from the I guess from a tech side is, how robust is the sort of the sort of technology sort of behind this in terms of, from a broader kind of network perspective, to allow this to really scale to the levels that we've kind of seen in TradFi. How far, what's the gap look like between allowing us to really kind of have a business and an industry that looks on the same kind of scale as what we've seen and still see within the traditional space?
I mean, if you look at the rate of innovation, the rate of adoption on this, it's phenomenal, right? And the fact that Alex and I, we can sit down quite quickly and figure out, okay, what are my needs with regards to the clients that I have, and and almost instantaneously just connect, and then be able to on-chain take risks off the table, for instance, or develop on our liquidity solution or staking products that
We've lost you there, Jesper. What are we thinking around? Obviously, we've had the launch of the Bitcoin ETFs, and now the push for the Ethereum ETFs. What are the thoughts around in terms of sort of how that might integrate with sort of staking, and what provisions are being made for that? Because again, I guess if kind of staking and the ETFs kind of come together, then again the sort of hedging around that becomes important again. What are your thoughts on the opportunity set there?
Well, I can lead in on this. So in Europe, we've seen the rise of ETPs have included staking, and also staking ETPs, and obviously, and this is in the public space, so I can speak to this. we work with the largest Canadian digital asset manager, 3iQ, who operates 2 vehicles in Ether, one spot and one staking ETF. And it's clear that that has sort of, they have written the rule book, so to speak, on how to include staking as a mechanism in their funds. And I think there's a lot of funds south of the Canadian border that are looking to, how are they going to incorporate that in their S1 filings. I mean, ETF managers have now figured out that the staking yield is not something they're going to leave on the table when they're going to offer Ether, for the reasons that, Chris was also mentioning earlier, either the utility of Ether. And this is super exciting because we're now seeing institutional investors moving into crypto, right? Participating in the network, having real interest in developing this ecosystem. And I think more so than just the inflow of capital, of course, that sort of invigorates and accelerates the rate of adoption of Ethereum and also other blockchain networks, as these massive infrastructure investments and infrastructure networks that can be leveraged for building new economies, and that's sort of for us super exciting. So we're working with them to try to figure out how to ensure that current but also future regulation can keep up. So how can they keep up with current regulation but also future regulation? And in Europe we have markets in crypto assets, of course, which is quite seminal in the sense that it's the first sort of comprehensive crypto regulatory framework for one of the largest economic zones in the world. So how do you, as an ETF manager, work in ensuring both the performance of your fund, but as well in a way that sort of satisfy the regulatory requirements that we're seeing currently? And so yeah, we're seeing a lot of interesting growth in this space.
Yeah, I mean, we talked earlier about Ethereum as being the internet bond, and why would you want to buy a bond if you're not allowed to have the coupon, right? It makes no sense. And when you look at the coupon here for Ethereum, it's actually very rich when you look at it through a real yield lens. The real yield of Ethereum is like at times twice that of the real yield of like US Treasuries, as an example, when you take into account inflation. Yeah, the nominal yield's higher, but like what really matters is the real yield after inflation. So it's a very powerful, exciting innovation within crypto. One of the challenges that we're finding, and Jesper is obviously very, very familiar with this space. He's working on solutions in this space. But the problem is that when it comes to an ETF, the unbonding and bonding period can impact the yields. So you can't just like wake up and start bonding your Ethereum and driving those staking rewards. And then there's times when the queue grows and it's harder to take it off, right? So that results in liquidity risk with the construction of the ETF. As a result, the Canadian regulators, as an example, are only allowing 50% of the Ethereum staked. Like, we'd be in much better position if we can get closer to 100%. I do think that's achievable. There's plenty of precedent for it in traditional markets. But again, like once you unleash that yield, you can do a lot of things with it, and then you can go over to Alex and create structured products by swapping it out, that yield, et cetera. And so I think getting, and by the way, in the US where I live, I don't expect yield anytime soon. I think that's going to really hurt the product. And so I think investors are going to think about perhaps other ways to gain access to that yield in the interim, synthetically or otherwise, total return swap or otherwise. But again, like that's what makes this so exciting, because it unlocks an entire array of structured products to cater to individual investor needs. So it's going to be an interesting landscape. I do think that the Ethereum ETF gets approved in the US this year. We saw Hong Kong move forward for, I think, April 30th. Canadians are out in front. So yeah, it's an exciting time, but what's the point if there's no yield?
Yeah, I agree. And that Hong Kong thing is quite interesting. We actually, the experience we have with APAC market has been phenomenal since we launched the project, and the speed at which that market moves on both the investors and the regulators is far superior to what we see in Europe or the United States. And the United States probably more for regulatory reasons. Europe is just structurally works a little bit differently. It takes a little bit longer. And I think that could drive a lot of demand. And another thing is on sort of the availability of yield within the ETP or ETF. I think ultimately it's all driven by the client demand, right? And that is informed by, that is created by clients being well informed about how that thing actually works, what's available. In TradFi, again, because we have the regulation, we have the history, everybody's been studying these things for decades. So everybody knows what can you do as a ETP, ETF manager, what can you do with the collateral. Everybody knows what the repo rate is, what's the allowable use of collateral is, and everybody can kind of calculate on the back of the envelope how much you could be making off that, and that everybody understands your economic case for it. And so the discussion is very different. And the discussion with the regulators is very different because it also comes from both sides. In our case, again, with increased transparency, as people understand a little bit better what's available with standardization, with all the things we spoke about, once the clients, the actual investors, individual and professional investors, understand a little bit better what kind of yield is attached to Ethereum, for example, I believe it's going to be table stakes. So everybody will want some kind of yield kicker to anything they do in Ethereum. There is no reason why they wouldn't want to participate in that. Just leave it to somebody with a different risk appetite. And we see what Hong Kong is doing. It will certainly drive jurisdictional competition, and hopefully the Western regulators will try to keep up, and we'll see it a little bit sooner rather than later.
Sure. How Alex, I mean, we talk about like standardization of contracts, which is obviously hugely important. I guess one of the big issues that I see is the fragmentation from a regulatory viewpoint in terms of across the various jurisdictions. How much of that is at the moment an impediment to the growth of the industry, and how are you dealing with those different regulatory regimes for essentially a borderless asset?
We're basically trying to make lemonade. That's kind of the only approach we've got for the time being. Like, look, there is not a lot of jurisdictions that offer any kind of regulatory clarity, right? So I think we're used to that in crypto by now. You know you're carrying some kind of reg risk. 5 years down the line, somebody can come back and say, I didn't like that thing you did when I didn't tell you what you should actually do. That happens to the best of us. So we know that might happen to us. In the meantime, there are some very obvious things that everybody knows regulators do not like. There is like KYC AML considerations. There are some other things. You shouldn't market highly leveraged structured products to retail, I don't know, in the UK and some other jurisdictions, right? Things like that. So you kind of take care of the sort of hygiene level requirements, and then you hope for the best in a way. And we're always trying to be a little bit ahead of the regulators, and some of the decisions we're taking ends up kind of informing the regulators of the preferred path. So we're working together on that.
Yeah, I can weigh in as well. I can weigh in as well. I mean, I think, I share the view that Alex has, but I also want to say that it's like we're seeing this split really, right, of the crypto market cap, where one piece is splitting out, becoming sort of further permissionless and decentralized, and that's great. There's a lot of innovation taking place there. And then the other half, if you like, is becoming regulated. That's regulated crypto, and that's also where institutionals live, right? Because they need counterparties, they need to observe existing regulatory frameworks and just, the law in general. And that opens up for regulatory arbitrage, right? But it also, this innovation tends to find the path of least resistance. But while we're still within sort of the regulated crypto realm, I think it's important to note that at least from our perspective, we like to think about crypto and blockchain needing to adopt, real world values in order to be able to scale at the level that we would like to. And that means that, we are actually in the forefront in terms of how to set those standards and those definitions, and educating not only ourselves, but regulators on what is this and what is it not, and what is the equivalent in the traditional space that makes you feel comfortable about, oh, this is just a use of technology in a different way than but from a concept that or product that I'm used to, right? And I think that is a quote unquote grown up conversation that you need to have in order to make sure that regulated crypto can scale, because the rate of innovation on the permissionless side and fully decentralized side will continue, but it will take time for those concepts to find its way into regulated crypto. So we're seeing that split, and that's where we live, and that's what we are sort of passionate about, making sure that we can work towards, because we believe that regulated crypto will, grow disproportionately at a disproportionate higher rate than the permissionless one at this point, because of institutional capital.
Yeah, let me chime in. I think in many jurisdictions, the rules around derivatives, crypto or not, are actually very clear after the global financial crisis. I mean, we went through this crisis, the G20 came out, we overhauled all derivatives regulations. That's the good news, is that there's a lot of clarity in many jurisdictions. The bad news is that a lot of that regulation forced centralization when we now have technology that gives alternatives. And so one of the jobs that, I try to do is work with global regulators to educate and engage them on some of the alternatives that still solve for the principles that they're looking for, in many cases even better. So I'm on the CFTC Global Markets Advisory Committee. If anyone's listening to this and they have advice or insight on how we should engage, I'm happy to take that right up to the CFTC. It's a process, but we're working through it, and it's a lot of hard work. But yeah, that's where we stand.
Yeah, and that's the, I think that's always the thing that's kind of frustrated me in this space, and particularly with the regulator, and is the fact that, done right and done well with the correct frameworks, that there should be an added kind of transparency around this space that actually, again, sort of solves for a lot of the issues we had in the traditional sort of world. So yeah, Chris, you're doing God's work for us there, I think, in terms of engaging sort of with them. So kudos for that. So Alex, what's next for Rolabs? What's the sort of big things that are kind of that immediate on your kind of roadmap and for the rest of this year?
We got a lot of stuff coming up. So we've been working hard for about a year, and we're about to one by one kind of announce all the things we've been working on. The first one was actually our partnership with CoinFund on the Caesar side of things. Hopefully be one of the first markets which will make Caesar liquid and tradable. And we completely coincidental, actually, we announced it on the same day when I believe Nothstake announced their partnership with the same counterparty as well. So we're kind of all very excited about what we can potentially do together in this very highly composable collaborative environment. And there's a lot of stuff coming up. We're going to have a big announcement probably next week, I would say, about something that's going to happen by the end of May. So everybody who's interested in interest rate derivatives or interest rates in general and want to know what we're doing, just keep an eye on our Twitter.
Well, sounds great. Well, I think that's probably a sort of good point to wrap things up. So yeah, thank you guys. Really interesting and great to see what's sort of being built in the space. And say particularly from my background, and I guess anyone from the traditional space, to see that evolution in crypto and what we're building is sort of fascinating. So yeah, thanks very much, and congrats to kind of everyone for the roles that they're playing within this.
Thanks, guys.
Thanks, guys.
Thanks, guys.
Pleasure to talk to you.